How we doing? Today is Thursday, November the 16th, 2023. Just coming to you with our deal review Thursdays. Each Thursday at 8:30, we review deals that are out there right now, and we just try to show people how we look to structure deals, look at different opportunities that are in the market for real estate notes that are already created and people are looking to sell. And like I said, we show, how we try to create financing for end buyers. So what we do is we show investors how to make an above average return by creating seller financed notes for end buyers who are going to live in the property. We do that by looking for sellers that may be somewhat distressed, maybe in certain situations that need to sell. And a lot of times will either allow us to take over the property subject to, which is where we take over the existing lien on the property, or what we try to do with a seller is create seller financing. And that basically means that the seller is extending terms to us. So then we can therefore offer terms to our buyer. So that's what we look to do. And what we want to do is just kind of go through and look at, some things that are out there right now, some opportunities, kind of go through, explain, the actual deal, how an investor or somebody who funds a deal could benefit from the particular deals that we find. So let's share the screen here. And so this is a property here. It's in Converse, Texas. And, we can take this address and try to see if we can find the photos on it. I think the photos are online. So as you can see here, these are some of the photos. Pretty clean property, very good condition. Looks like it was fixed up. Let me see if I can find some more photos as well. Go to my email. See if we can find it. Here we go. So I think this has, yeah, these are the same photos, but I thought there were more photos, but as you can see, it's pretty clean property. Not like, you're gonna have to go fix it up. This property right now is move-in ready. So we'll just walk through it here. We're not gonna have to put any money in there. We just usually just put 1,000, just to put something in there. This is a calculator that kind of shows us how our options for exiting the deal and to show us, our potential profit on the deal. So we're looking at a value of about $315,000, but a lot of times for modeling purposes, we want to stay on the more conservative side. So we may come in under, because if the deal works with us coming in under what the value is, then we know that, once we do move forward with this deal, we're probably going to be able to sell it for more. So we're going to take it over subject to. Here is the underlying information, underlying mortgage information on this particular property. So this property is on the market. It's not selling to traditional buyers who are going to get qualified. And you may say, well, if they can't sell it online, then what makes you think you can sell it? Because what we do is we offer financing to a buyer. So while we have more pool of buyers that we can go to get them qualified for this house. A lot of people that are going to banks right now are not being able to get qualified. They have solid credit, they earn good money, they may, have a significant down payment and things of that nature, but they don't dot every I and cross every T for the banks. So you're seeing, anywhere between, 5 to 6 people out of 10 that are not getting qualified. So when we go and look for a buyer, we are looking, at a bigger pool of people who could potentially live in this house, earn enough money. And what we do is we send them to a residential mortgage originator so we can make sure that they are qualified properly. We don't just put anybody in a property. We'd rather have this property sit maybe for a month or two, even 3 months before we put the wrong person in. So we want to make sure that mortgage loan officer, feels extremely confident that this person, they've checked all their finances and everything like that, and they know that they can afford the house. So in order to get the house, this is coming to us through a wholesaler. So there are some fees and some things like that to actually take down the property. And what you'll see here is total acquisition cost. This is what it's going to cost us to be able to take down this property, pay who we need to pay. There's a realtor involved, there's a wholesaler involved, and some other things involved in closing a transaction, closing costs, things of that nature. So right now, this loan is 3.25%. And this what makes the deal really attractive because it has such a low interest rate. And this is what we are seeing. We're seeing, based on the COVID years and everything like that, when interest rates went really low, and if people are having issues, these are the types of loans that we're attracted to, that we look for, because they have such a low interest rate. And this is the value in the deal, the low interest rate that can stay in place for a number of years. So they're paying right now principal, interest, taxes, and insurance about $1,800. And again, this is affordable. This is considered an affordable market. A lot of markets is $3,500, $4,500, $5,000 or more dollars to live in a house. So this is why, another reason why we look in these particular areas, because it is affordable. There's over 340 months left on this. Now, there are solar panels. So these are some of the other costs that are going into this particular deal. So we have to factor in the fact that we have to pay this $115.13 each month until this $23,000 solar panel is paid off. And as you can see, we have that in here as well. And then on top of that, the seller, because they didn't, they have a certain amount of equity that they're looking at, that they think the property is probably worth about $315,000. They only owe $250,000. That's their equity. So instead of taking their equity now, what they're doing is saying, we'll take it over time, which is smart. If you're not selling your property, if it's not moving for whatever reason, you have equity, but you have some place to go, you have some type of life event that you need to be able to move from this property and go on about what it is that you need to go about in your life. This is a great way to do that. And they're asking for a little over $58,000 at 0% interest. So we're just paying this down each month until it gets paid off. So we've got time to kind of get this paid off. I don't believe on this one there was any type of balloon. They're just looking, to get this paid out over time. So obviously they don't maybe need this chunk of money right now, but they don't want to lose it, so to speak. So they'd rather take it each month. So that's another cost that we're going to have to incur on this one. So again, we looked at it at $300,000. And what we would do is, there's the first lien. We have the funder come in with this $27,500. They're going to be in second position. So you're going to be secured against that first lien of $250,000 at a 3.25 interest rate. So you would be loaning that money to us as, our business, but it is going to be a lien against the property. So if something were to happen to the company, we didn't pay you, whatever the case may be, you still have a secured lien against the property. And, you could foreclose against the property from second position and be able to continue doing something in the future with the property. But there's no reason for us not to pay you because of we want to keep this loan that's in place as well. We want to keep it there. We want to make sure that you get paid, and we're going to pay it in a way where it's fully amortized, which you'll see at the end. So if something happens to us, you still have the buyer that we put in the property that is making the payment. So the money is going to, be dispersed to a third party to you each and every month to make sure that you get paid. So, that should bring down, the worry about getting paid and being in second position. And if worst case scenario, like I said, you take over a $250,000 loan on a $300,000 property. Again, we do have to pay the seller back. We still have to pay those solar panels, but you would be able to then be in control of the deal if for whatever reason we didn't pay you. So we're going to write 2 mortgages. They're going to go in third and fourth position for the end buyer. We're looking at, getting about 10% down on each of the loans. So as you can see, $270,000 is going to be financed. It's going to be $225,000 on the first and $45,000 on the second. And for this example, we're writing it at about 9.5% interest. We may be able to get a little bit more. It depends on who the actual buyer of the property is. So you'll see the payment here is a little over, just around $2,200. Again, affordable when you're talking about buying a house. With their taxes, with their insurance and everything like that, maybe they're around $2,500. That's not considered, out of the realm of someone who is purchasing a house, not a renter, someone who is owning a house to pay about $2,500, $2,600 in any given market. And so this is how it would break down for the person funding the deal. We're going to fully amortize it over 60 months. So that means that you as the funder are going to get paid back, fully within 60 months. And in this example, we could go up to about 18%. Obviously, we'd like to, we'd like to be less than that. We'd like to pay a solid return to an investor, but just to show you for illustration purposes, we could go as high as 18% to pay this particular person that funds this deal. And we're still making cash flow. We would be making about $170 of cash flow right now until this gets fully paid off. Once we paid our funder off, then obviously we are, going to make the $170 plus, as you can see here, $698. So roughly $800 worth of cash flow, almost $900, and that's after the 60 months. So, this is, again, these are the types of deals that we like to put together and create homeowners with this type of deal. And then, on the screen here says like after 100 months, that's usually, maybe about average about how long somebody stays in the house, 10, 12 years, something like that. There's still going to be a payout, at that particular time on that deal. When that person maybe sells the property, whatever the case may be, maybe they refinance it at a certain time. After about 100 months, there's still a payoff. Usually these go longer, but if somebody wants to refinance, whatever the case may be, they can do that. And even at that particular time, we could actually refinance this person at that time, because then the clock starts all over again. So they've been in that property, 90 months, 95 months, 100 months, and then they want to refinance. Could we not at that point, take our interest rate of 9.5 and maybe go down to 7, 6.5? Maybe what, what the given interest rate is at that particular time. Maybe we could do that. And the reason why we could do that is because that first is still paying down. So we're going to be restarting the clock on another 30-year mortgage, but we would have been then paid this down over another 10 years. So what will be the balance? I'll go back and I can tell you right here. It shows you in 10 years, let's say 100 months. So in 100 months, we would owe $200,000. Then we refinance them. We're going to refinance them based on the value of the property in 10 years. or 12 years? What is that going to be? Or let's just say it's less than that. Maybe it's 5 years. What would it be in 5 years? Let's say it didn't move. If it didn't move and it was still worth 300 or 315,000, now we've got an even bigger spread. Now we've got $100,000 in there. That's a difference that, if they did sell the property after we refinanced them, that they would still owe us a large chunk of money at that particular time. And we were able to refinance them. They didn't have to go to a bank to go get refinanced at that time. So again, that's another reason why, we like to, put these deals together this particular way, just because of how they play out over the long term. We're willing to take less cash flow right now because of the payoff down the future and the fact that we have this low interest rate that we could keep in place. Maybe the person wants to sell the property. Could we not, and in 10 years, pay them what their equity is? What is their equity in 10 years? Let's look at it here. So in 100 months, they would roughly have about maybe, 100,000? No, it's not that. That's not right. Oh, wait, that's the first one. So that's 209. Then they have the second. So you got to add these two up after 100 months. 209 and 40. So that's about 250. So maybe they would have $50,000. At that time, maybe we could, then borrow another $50,000 to get them paid out. Put that person that's now, funding the deal at that particular time. That person then moves, but we still have this loan at this low interest rate where we can go and then put another buyer again, and then the clock starts all over again. Again, is it worth 300, 350, 330,000 maybe in 10 years? Heck, it could be worth, 350, 375, and we've started the clock all over again, and we're still paying down this original mortgage that we had if that person wanted to sell. Okay, you want to sell? Okay, great. We'll give you XYZ, for the equity. This is how much equity you have in a property. If you were to do a realtor, your closing costs, whatever, what is that, in number that you want to walk away with? So if we give that to you right now, give us the property back, and then we start this all over again. And then by the time, if you do it again, pretty soon this house is going to pay off, and then you're going to have it free and clear, in which you can, pass down to your kids and stuff like that. So these are the reasons why we like the deals, because of the long-term gains. We get some of the stuff short-term as well. There is some cash that we'll get when a person, that we put in the property, puts their down payment and everything like that. We'll be able to walk away once we, put someone into the property with some money for right now, get a little cash flow. At a certain point, we've paid our funder back, our initial funder, so we start getting more cash flow, and then we'll see what happens down the line if the person wants to sell, refinance at that particular time, and then be able to address that later on. So that's, what we look to do, how we can pay, we can pay a realtor, we can pay a wholesaler, we can pay the funder, very good interest rates, higher, above average interest rates, and the deal still makes sense for us now as well as down the road. And that's why we like to structure these. And that's what we do here on Thursdays, is that we take a look, at these particular deals. This deal is something that came just a couple of days ago that we looked at. So there's things all the time coming, as this market changes. There are going to be issues. There are going to be people that need help. There's still going to be people out there that look to buy. Maybe they can't get approved, through a bank. Liquidity is tightening. Banks are tightening. It's a perfect storm, so to speak. You have people who are going to have issues, who have low interest mortgages. You have other people over here who can't necessarily go to a bank and get the financing or get a mortgage that they want right now. And so we kind of solve that problem by structuring these deals this particular way. And, we look for people that want to join us, that, want to joint venture with us, would like to potentially fund deals like this. As you can see, it's a very nice property, move-in ready. Somebody's getting a nice quality house for their family. And that's what we want to do. We want to create homeowners. We don't want to, continue this renter type of thing. And then, in an affordable market, not every market is affordable, but some of these southern markets, some out west, like Arizona has some, areas that are affordable. And there are other areas in the Midwest and different parts that, this can work for. So, that's what we're doing. That's what we do here on Thursdays is we show you these particular deals. Next Thursday, we'll probably deal with a note that is, for sale. Been kind of focusing on this side of it for right now, putting together these seller financed wrap deals. But there are real estate notes that have already been set up that people are looking to sell because of the market. Again, they want to get that cash. People are looking to get cash to put into other investments. They're gearing up their cash because they want to invest in some of these other things that they see coming. There's things in the commercial market. So there's people that are at a different level in this game that are putting together, hundreds of thousands, millions of dollars. And the way that they do that, a lot of times that they're selling off their portfolios of notes that they have. And there's an ability for people who are not at that level, that high level, just starting out, in this thing that can buy, 1, 2 notes at a time and start to build that way. And, we'll look at those deals as well. So we'll do that. I'll make sure that I find 1 or 2 for next week to kind of go over and show you some of the stuff that is out there. And with the notes that are already created, they may not be this 27,000. You can find something for under that, for under 20 grand, maybe under 15 grand that you may be able to buy, get a solid return on, be the bank, just collect the payments, and make sure that the payments keep coming in. If they don't, for whatever reason down the line, then we can handle that situation at that particular time. But, there are things that could be a little bit more than 30 grand. Maybe there's 50 or 75 grand that you have that you want to invest. And there's some opportunities to do that as well. So we'll look at those next week. I'll make sure that I, find a couple that we can look at in a couple of different price ranges. So, I will post this on my YouTube channel. You can take a look at it. We've done a couple of these already, so you can go back and check those out, but this will be the most recent one that we'll post on there. All right. I will talk to everybody next Thursday for the deal review. We do go live on Tuesdays and Thursdays in the evening. You can look for me on Instagram. I'm streaming live here on Instagram as well. Obviously, if you're on Instagram, you can't see the screen, but you'll be able to hear what I'm saying. And we go Tuesdays, again, we just kind of answer questions, help people learn about notes, talk about real estate note investing, buying notes, selling notes, things of that nature. So you can catch us there. And then Monday through Thursday, 12:30 Eastern Standard Time. If you have some time in the middle of the day, we go live. We do, we talk about some different things and address some things there. You can always catch those replays on the Instagram channel. All right. Have a good night, and we'll talk to you soon.